So, good morning to all. Thank you very much for your presence on my thesis defense. I'm Carolina, and today I will present my thesis named The Impact of Carbon Emissions on Low Carbon Index Performance and Evidence from International Carbon Index. My presentation will have 7 parts. First of all, introduction to research framework, literature review and research gap, research question and objectives, methodology, data and results and performance analysis, and final considerations. In recent years, climate change has emerging as one of the biggest problems global environment, social and economic threats. The main causes of the global warming are the mass industrialization, the burning of the increasing amounts of oil, coal and petrol, deforestation and monoculture. These activities are increasing the amount of greenhouse gases, being one of the main causes of climate change. It's increasingly recognized that the climate change impacts almost every economic sector, and ignoring it can be result in incorrect assessment of risk and returns. Consequently, there is a growing interest in understand how climate risks affects investments portfolios. Since the investors cannot ignore that climate impact. Given the focus of the article on low carbon investments, and it's imperative to evaluate conventional investments in the context of green finance. During the last years, several studies suggest that following the Paris Agreement, low carbon assets have become more attractive to investors. Banks and investors with intensive carbon assets face a significant financial risks, and they need to reevaluate the portfolios and adopt ESG criteria to avoid losses. Also, investors who are following the corporate social responsibility criteria reward the companies with low carbon emissions and penalize those with high carbon emissions. Some authors say that investment fund managers began to reduce their holdings of high carbon companies. Gabriel et al. In 2022 analyzed low carbon stocks and found that low carbon assets provide a strong option for portfolio diversification. No consistent evidence of green stocks consistently outperforming brown stocks in risk-adjusted returns. Bolton et al. Analyzed US stocks and using Fama-French and Carhart models with a carbon risk factor, and found that companies with carbon-intensive emissions tend to have a lower risk-adjusted returns. The literature review reveals several significant gaps on study of low carbon investments, highlighting the need for the new research in this area, specifically in the methods used. The main 3 gaps are the lack of direct systematic comparison between low carbon and high carbon index, limited regional focus, and use of traditional performance evaluation models. Given the growing impact of climate change and the sufficient knowledge about that society has about low carbon investments, there is a need to better understand how this change can affect the investment portfolio and strategies. In this context, our research question arises: do low carbon index have a higher risk-adjusted return compared to a carbon index in US and Europe? In order to answer all this to this research question, the research objectives are: first of all, determine either low carbon index have a positive and statistically significant alphas compared to carbon intensive index. Secondly, analyze the explanatory capacity of the models, which are Jensen alpha, Carhart's 4-factor model, Fama-French 5-factor model, and 5-factor model with a volatility factor. And for last, compare either low carbon index have a higher risk-adjusted returns than a carbon-intensive index, taking into the factor loadings. 4 methods were selected that are the most effective for analyzing the historical portfolio returns. For the first model, we choose Jensen's alpha. The model addressed discrepancies in the CAPM model, which assume that finance assets prices fully available information, which is not correctly right. This model introduced the concept of alpha, measuring the difference between a portfolio actual return and its expected return. For the second model, we choose Carhart's 4-factor model. This model extends the 3-factor by adding a momentum factor that captures the tendency of stocks to have performed well to continue performing well. The third model that we choose is from a French 5-factor model. The model builds on 3-factor model by having 2 factors, the profitability and investment. This extension addresses anomalies in asset returns that it's not explained by CAPM or 3-factor models, providing a more comprehensive 2 stock returns. For last model, we expanded our analysis by adding a volatility factor on 5-factor model, using the VIC for the US region and the V-stocks to the Europe region. This index measured the expected future market volatility and are often named by investors as a fear indicator. Regarding our data, our sample focus on carbon index in US and Europe from 2016 March to March 2024. The sample is innovative, targeting 10 low carbon index and 4 carbon index. The daily price was extracted from Refinitiv data stream and converted into returns. We analyzed the performance on the both low carbon index and carbon intensive index at 2 levels, the individual performance and the aggregated performance. 2 portfolios were constructed, one equally weighted and one value weighted. For low carbon benchmark index, we use both conventional index and the social responsibility index, and for carbon intensive indexes benchmark, we apply the conventional index and energy sector benchmark index. We also use the VIX for the US region and VSTOXX for the European region to capture the market volatility. Regarding our results, in United States, the low carbon index compared to SP 500 seems offer more stable returns with lower volatility. The addition of the VIX factor indicated that the volatility does not significantly affect the carbon index, suggesting that low carbon index are less sensitive to the market fluctuations, which may reduce the risks, but also limit the potential return. Compared to the stock 1800 global low carbon portfolios underperform, but the VIX result shows that shows lower volatility compared to SP 500, suggesting that the portfolios may be even less volatility investment strategy, which be attractive to investors who are seeking to reduce their risk while maintaining some profits and returns. The SMB factor revealed that the small companies associated with a smaller low carbon footprint tend to have higher returns. The HML factor showed that the growing stocks outperformed, and companies with thicker operation margins are more aggressive strategy and outperformed as well. Regarding Europe, investing in a low carbon European index does not generate higher returns. The equally valued portfolios indicate lower volatility and sensitive to the market fluctuations, which is positive for more risk-averse investors. The portfolio value-weighted reflect higher volatility. The inclusion of the VSTOXX volatility factor did not result in a significant improvement of the results, suggesting that volatility is not a crucial factor in explaining the returns of Europe low-carbon portfolios. The HML factor suggests that growth stocks outperformed. The RMW factor indicates that the companies with weaker margins also outperformed. Regarding US carbon intensive index discussion, we can say that carbon index portfolios showed lower than expected returns. Portfolios compared to the 500 to the SP 500 suggest a greater sensitive to the market fluctuations. The reference to the MSCI high energy indicates less sensitivity to the index, indicating that portfolios may offer a different risk exposures. The addition of VIX volatility factor improved the explanation of returns. The HML factor indicated that stocks booked to market value were more profitable, and the CMA factor suggests that companies with more conservative characteristics also outperformed. Regarding Europe-US carbon intensive index, the portfolios analyzed with the stock Europe 600 outperformed the benchmark. In contrast, when compared to the MSCI high energy Europe, the portfolios show lower returns. The portfolios compared to the stock Europe 600 suggest a greater sensitivity to market change when compared to the MSCI Europe Energy. The high IML factor and the momentum factor suggest that based valued strategy and recent trend following strategies can be more profitable. The CMA factor suggests that investing in companies with more conservative strategies are more profitable to investors. As a final considerations, the carbon portfolios analysis is fundamental to sustainable investment decisions, and it's crucial to consider associated risks, market sensitive, and volatility. Based on our research question, we can conclude that in both US and Europe, low carbon index tend to offer a more stable returns investment strategy, less volatility, and less sensitive to the market fluctuations when compared to the carbon intensive indexes, which might be good for investors who are looking for lower risk. However, we did not find clear evidence that low carbon index generates higher risk-adjusted returns than carbon intensive index. Despite that, low carbon index may be a good option for investors who prioritize the lower risk because they are less volatility and less sensitive to the market fluctuations, while carbon intensive index tend to be more sensitive to market fluctuations. With this research, investors and financial institutions should carefully evaluate the factors and align them to their financial objectives and risk tolerance. And finally, I've reached out to the end of my presentation. I would like to thank to my supervisor, Professor Afshin, and Professor Pedro and Professor Jorge for your presence. Thank you very much.